Wonderful. All right, terrific. So thank you all so much for being here today. I'm absolutely delighted to be leading our first panel of the morning. The topic of the panel is the financial sector, and I just want to give a few brief introductory remarks before I introduce our panelists. To reach net zero by 2050, the International Energy Agency has estimated that annual clean energy investment globally must more than triple by 2030 to approximately $4 trillion annually. The Paris Agreement on Climate Change calls for making the allocation of capital consistent with a pathway to net zero in that time frame. Private financial institutions like banks, asset management firms, private equity, insurance firms, and others are taking active steps to promote a smooth transition to a net zero economy, both to address climate risks and to take advantage of climate opportunities. And regulators, both in Europe and in the United States, are likewise grappling with how to promote a smooth transition and harmonize capital allocation with these goals. This panel today will discuss what these regulators and private firms can do and must do to address these crises, what more they can do to promote a smooth transition to a net zero economy going forward. So I'd like to just take a moment to introduce our extremely distinguished panelists for today. Our first panelist is Kalina Nevyans, who has our European flags behind him. Kalina is the Chief Financial Officer and member of the Management Board of the European Stability Mechanism and European Financial Stability Facility. Before taking on the CFO position, Kalina was the Secretary General responsible for many areas, including corporate governance, shareholder relations, human relations, finance, and control. He previously worked in strategy at the European Investment Bank at Luxembourg, corporate finance advisory at McKinsey & Company in the Netherlands, and investment banking at JP Morgan in London. He has also held several political positions in the Netherlands. Kalina holds an MSc in Business Administration from the Rotterdam School of Management and Wharton at the University of Pennsylvania. Our next panelist, Brian Lehman, also a graduate of the Wharton School, MBA 2002, is currently the Managing Director and Head of Green Economy Banking at JP Morgan Chase. Previously, he served as the head of the Corporate Client Diversified Financials Group. In addition to his MBA from Wharton, Brian also holds an MPhil from the University of Cambridge in International Relations and Affairs. Our third panelist is Elizabeth Lewis, who is Managing Director and Deputy Head of ESG at Blackstone. Elizabeth has spent most of her career in climate solutions, investing in private equity, including many years at Global Environmental Fund. Previously, she led climate strategy at the International Finance Corporation, the private sector arm of the World Bank. Earlier in her career, she established the Sustainable Investment Program at the World Resources Institute, the leading nonprofit climate change standard setter. And she too holds an MBA, although hers is from Harvard. We will still welcome her with open arms onto this panel. Thank you so much. So with those introductions in mind, I just want to give you all a sense of what to expect. None of the panelists are going to be giving prepared opening remarks. We're going to have really a moderated discussion. I will lead the discussion for the first 45 minutes or so of our time together, and then I will moderate Q&A. So if anyone has questions, you can click on the Q&A button below, or you can submit them in the chat, and I will moderate the Q&A portion. All right, so with those introductions in mind, you're more interested in hearing from the panelists than from me. So let's get right to it. Kalina, I'd like to start with you. Why are financial regulators and institutions in Europe focusing on issues related to climate change at all? Can you explain how climate change constitutes a financial risk, let alone a systemic financial risk? Oh, and you're on mute. Wait, you have to unmute yourself first.
Thank you, Sarah, and thank you for having me. And it's really great to be virtually back in Philly, despite the fact that I'm here in Luxembourg. Well, a very good and sharp question. And let me first start with a more general remark and then more specifically with why we think this is very important. So climate change does constitute a real risk for societies and economies. And we in the European Union have invested a lot of time to start addressing climate change with different measures, including finance. And yeah, you mentioned that I have a Dutch background. We do see countries like my own, the Netherlands, really being affected on the long term by climate change. I grew up in a city that is 4 meters down sea level. In the next decades, it's predicted to be around 10 meters below sea level because of the rising sea levels. At the same time, the bottom that is getting lower. So this is a real risk, which is a real financial risk, which means that we need to increase dikes. That means more fiscal policy, means creating wetlands. It creates moving bigger cities like Amsterdam to other places. So this all can constitute real financial and economic risks for the future. More specifically, I work, as you said, at the European Stability Mechanism. We are the Euro Area Crisis Resolution Fund. So we help when crises happen in Europe. There was a great financial crisis, which led to the Euro crisis for us, where sovereigns lost market access. And here, a bit like the International Monetary Fund in Washington, D.C., we had to help European countries that were hit by this crisis. If you look forward, we currently are in the middle of a different crisis, the pandemic crisis, where we have created a pandemic crisis response tool where countries can borrow money from us. But obviously, we look on the long term and what are the crises to expect. And climate risk, climate crisis are the ones that are coming at us in the coming decades. Now, as Europe, we have taken several steps, and you might have seen that. Europe signed beginning of this year the Green Deal, where all 27 countries of the EU agreed to go for net zero by 2050. This is the biggest commitment that has been made globally at this moment by any of the countries. And this summer we saw why it's needed. You might have seen it on TV, but Europe was hit by floods. By huge floods. Even in July, when I opened my window, the village where I live in Luxembourg was flooded. So we had our neighbors in Germany and Belgium really lost people's lives, human lives. And this is the heart of Europe where this is happening. So with the Green Deal, the ambition on a European level is to go to net zero by 2050. We even have a more ambitious German government since this month. They have even the Green Party in government. They want to go to 2045, so even earlier. Now, it's not only these big political ambitions, but finance plays a big role. So if you look at it at the moment, all sustainable finance that happens globally is largely denominated in euro. So 50%, and I hope Elizabeth and Brian will look into that, but around 50% of all the issuances in ESG is denominated in euro, around 27% in US dollar. The major issuers at the moment still come from Europe. We've seen Italy come out with a green bond. We've seen Spain come out with a green bond. So we see that this is an area where Europe is trying to lead, but we only can solve climate change if we work together, right? So we have to have a global solution. So we need to bring our friends in the US, but also our friends in Asia on board, that we really boost climate finance and sustainable finance.
Wonderful. Thank you so much. Brian, I'd like to turn to you. So all 6 of the largest banks in the United States have now publicly committed to aligning themselves with the principles of the Paris Agreement on climate change to become net zero emissions, not only in their operations, but also in their lending portfolios by 2050. In doing so, they join major global banks that have made similar commitments. Can you help us understand why climate change has become such an issue of importance for global banks to address? What is motivating banks? And relatedly, what does it mean to be the head of green economy banking at JP Morgan? And what does that group work on?
Sure. Sarah, thank you very much for inviting me to this panel. And so maybe first I can start with that. And apologies, I'm just a little under the weather. Banks' responsibility really is to promote safety and soundness in the financial system, right? And so I think all of us on the panel and anyone who's plugged into the Zoom call would agree that climate change is real. It's no one can dispute its impacts, not just on the welfare, as Kellen had just mentioned, of people locally, given extreme weather patterns and the impact overall and on global GDP. And so banks have a responsibility. JP Morgan has a responsibility to promote the safety and soundness of the financial system where climate change is having a meaningful impact. If we also think about our constituents, investors, right? Investors want financial institutions, the leading financial institutions, to not just respond, but lead. And JP Morgan has taken a number of steps to demonstrate leadership. I mean, let's take a snapshot over the course of the last 12 months, and it does dovetail into the green economy. But aligning ourselves with the Paris Agreement, that was October of last year, establishing what we call the Center for Carbon Transition, which is to help folks at all parts of the energy transition get to a better place, which is a less carbon intensive future. And the way JP Morgan ultimately can do that is to provide a specific carbon compass methodology to provide a roadmap, not just to investors, but also to clients in terms of where we are and ultimately where we need to go over time. And so investors have spoken, and now, right, it's institutional investors, it's consumers have also voiced their opinion. There's never been so much of a groundswell of support for mission orientation, recognizing that climate change is real. And JP Morgan has a responsibility to all consumers, right, who deposit money with JP Morgan to align ourselves for a lower carbon future. But it's not just those defensive measures that could be perceived as defensive measures. JP Morgan is demonstrating leadership in playing offense, right? The commercial opportunity that exists within promoting a decarbonized future, that's my job. That's how the green economy was established. If we think about JP Morgan more broadly, the responsibility is there. We've established a commitment of $2.5 trillion over the course of the next 10 years around sustainable development. Within that $2.5 trillion commitment, we have a $1 trillion commitment towards green initiatives. And so the green economy specifically is focused on 5 verticals where the common thread is to help decarbonize the globe through promoting technologies and attracting capital. And the way we meet those commitments is by committing capital to clients and raising capital on behalf of clients. So I love the notion of ESG and green bond financing. Those things are incredibly critical. But a lot of these advanced technologies, you think about nuclear fusion, direct air capture, so many technologies that are required to get to this lower carbon future need not just investment grade capital, but they need equity. They need hybrid securities. They need to attract a different investor base that will align themselves with the risk and the associated reward. And so we're focused very much on that. The last is policy, right? The infrastructure bill, the focus on climate is as acute as it's ever been, and rightfully so. And so JP Morgan playing its part within that ecosystem is incredibly important.
Great, thank you. Elizabeth, I'd like to turn to you. Your role at Blackstone focuses on managing ESG factors, including climate-related risks and opportunities. How does Blackstone think about integrating sustainability and climate change into its assessment of and work with its portfolio companies?
Thank you, Sarah. Yeah, it's so great to be here with my other great panelists. Thank you for having me. This is such an important topic, I think, such a critical part of business education today. So I'm really excited to see that this event is happening. So at Blackstone, so just a little bit of an overview on Blackstone. We're one of the largest asset managers in the world. We invest across all asset classes and all sectors. So when we're thinking about, so climate risk is systemic, as we know, and so climate risk And also, I think climate opportunities are important for us to consider across all of the asset classes. So just as an example, we are one of the largest real estate owners in the world. We have a large private equity portfolio. We have an infrastructure portfolio, and we also have private credit. We invest in hedge funds. So we also have some exposure to public equities as well. So we've been thinking about this through a lot of different lenses. So I think fundamentally, at Blackstone, we believe strongly that sustainable companies are more valuable over the long term and more resilient. And this is borne out now in research, right? There's empirical research that shows this, thankfully. And it's also borne out by our own experience. So we've had a chief sustainability officer at Blackstone for over a decade, and we've been working over that time with our companies to put them on a lower carbon trajectory. Of course, the urgency of the situation has only grown during that time, and we've learned a lot during that time. So now we have, I think, a very impressive climate program in place, and we are taking the risks and opportunities into account in a few ways. So I'll just lay out at sort of a high level what we're doing. So across all of the sectors that we're investing in, so any portfolio company that comes into our investments, where we control energy usage, we've committed to partnering with these companies to help them reduce their carbon emissions on a trajectory that is informed by climate science. So 5% per year over the first 3 years of ownership in aggregate. So this is helping our companies really get on this lower carbon trajectory, get on the pathway that is aligned to the Paris Agreement, right, which calls for essentially 4.5% per year from now until 2050 to reach net zero. And I can talk a little bit about how we do this, but I think private equity is a very powerful model for being able to actually work with companies and get them to own sustainability and really make operational changes that are meaningful. We're very hands-on, and this is a way where being hands-on is really important and impactful. The second thing that we're doing on climate that's a major initiative is a carbon footprinting exercise. So we're now doing a carbon footprint of our entire real estate portfolio and all of our companies where we have majority control. So it's a huge undertaking. Some companies, of course, are doing this already. They don't really need any help from us, but others certainly need our help and our support to do this. And we see that as a big value add, because you need to know your carbon footprint, to be a strong leading company in today's world. And so in addition to our commitments, our target commitments on emissions reduction, this carbon footprint will allow us to have even more impact, right? And to just help our companies even more. The third thing that we're doing with all of our companies across all sectors is starting a program on physical climate risk. So obviously this is extremely important for our real estate portfolio, but it's really important for all of our other investments as well. And we are sort of expanding that over our whole portfolio, but we know that that's very important. And I think the last thing that I would mention, and this is right to Brian's point on the solutions that don't fully exist today, right? The solutions do not exist today in the world at commercial scale for us to meet net zero by 2050. And so we are investing at scale into companies that support the energy transition and companies that support net zero, not just in renewable energy. Of course, we're all familiar with the great advances in renewable energy, battery storage, but also things like microgrids, grid stability, sustainable agriculture companies, financing mechanisms, right, to increase the flow of capital to all of these technologies that are out there. So since 2019, we've invested $10 billion in the energy transition, and we have it's become a major theme, I would say, across several of our different funds. So we see this as an exciting opportunity, and we're investing, directly into the world of climate solutions in a seriously impactful way.
Great, thank you so much. It's really great also to hear the specific details, everything like the carbon footprinting exercise that you're doing across. That really provides a lot of insight for people who aren't at Blackstone, for students, for others who are interested in going into these areas. I think it's really helpful to understand kind of at a day-to-day level, what does it mean when a company like Blackstone or a company like JP Morgan is actually making these commitments to work with its companies? So Elizabeth, I want to turn back to you for just a moment to ask you about another hat that you've worn in the past, which is that prior to your time at Blackstone, you worked at the International Finance Corporation. What role do you think international financial institutions like the IFC and the World Bank can and should play in addressing climate risk?
Yeah, I think that's a great question. So I think the development finance institutions, the World Bank, the IFC, which is the private sector part of the World Bank Group where I came from, and other development finance institutions have just a critically important role to play in solving climate change, right, and helping us all address climate change. I mean, we all know that we can't afford to develop the whole world and have the emerging markets develop in the same way that the developed markets did, right? We can't afford to have them develop using fossil fuels and then switch later over time, as we are now in the developed world, to clean energy sources. It's critical that they develop in a clean way, and that we all work together to make that possible, because we have the technologies in place, a lot of the technologies to be able to do that. And so it's really a question of financing in institutions and where capital is flowing. And this is exactly what the development finance institutions, right, are expert at. So climate change should be no different. I think, one important thing to just point out is that the governments, developed and undeveloped, right, and emerging markets, we don't have enough money in the governments to be able to assure this clean development around the world. So the private sector is critical, right? That we need to move from what they say, the billions to the trillions. We need to move from billions of dollars to trillions of dollars in emerging markets to be able to support this clean development. And I think that's where the DFIs have a really important role to play. The reason, there are many reasons and many experts that are far more knowledgeable than me, but there are some basic things that have been identified as to why private sector investors aren't going at scale into emerging markets. And I think the development finance institutions sit at this really interesting place where they can help drive more and attract more capital at scale into emerging markets, right? So, I mean, one problem that has been identified and that these DFIs are working on is that often these countries don't have the institutional capacity to create markets that are attractive from a risk-adjusted return for the private sector investors. But the ways of addressing that are known, right? And so the DFIs, the World Bank and others can come in with sort of a playbook of things that governments can do to create a market that is understood and that is easy to access. So just one example is with renewable energy tendering, the process for tendering renewable energy, right? There are certain things that you can do to make markets competitive, to make them attractive, and to create bidding systems so that private sector can come in very easily and access that market. And again, these are huge, great market opportunities for investors. So I think that the problem is not on the demand side necessarily. It really is on sort of the creating the flow and creating the systems to be able to bring in the private capital. I think another thing is concessional finance, right? So creating financing structures such that private investors feel comfortable that they are going to get sort of a market rate return, because there are concessional finance vehicles that the DFIs and others can provide to basically de-risk these markets and make them attractive. So I think those are really important things. So I think again, it's really not about the technology. It's not about the market opportunity, which is clearly there. It's really about creating flexible and accessible tools to bridge the gap from this limited pool of government financing that we have available that has to address many problems around the world, not just climate, to be able to make it attractive to bring in the trillions of dollars from the private sector.
Great. That's really helpful. So speaking of trillions of dollars from the private sector, now I'd like to turn to Brian and talk to you a little bit more about if you could go into some of the specifics about what private firms like JP Morgan, other banks in your industry are doing in order to help create these markets or to plug into these markets. So we often speak in terms of climate risks, but I'd love to ask you to focus a little bit on the climate related opportunities. Where do you see the biggest and most important opportunities? And how does JP Morgan allocate capital in ways to seek out those opportunities?
Sure, Sarah. So maybe what I could do is just articulate the strategy around the green economy, and hopefully that'll give you an idea for how we're going after what we view as an amazing opportunity. So we focus on 5 verticals. It's renewable energy, right? It's not just the producers of clean energy, it's the manufacturers of the equipment that would go into producing clean energy. We focused on sustainable finance. So anybody who's putting third-party capital to work within the green economy ecosystem, we care about them, right? So it could be accelerators, venture capital, private equity, right, late stage growth. It could be permanent capital vehicles. It could be solar finance platforms, infra funds. So it's important because also if we think about where the trends are going from an institutional investing standpoint, now it's 40% of the investable assets globally have a net zero pledge by 2050, right? So attracting that capital to the opportunity, that's what investment banks are meant to do. Food tech and ag tech, right? It's away from the renewable platform, which arguably is incredibly important, but equally the safety and soundness of the food system, delivering the food system in a less carbon intensive way is incredibly important through artificial intelligence, robotics, vertical farming, alternative proteins, even insect protein. There's such a vast world out there that needs capital, right? And particularly for capital intensive businesses. So then it's efficiency technology. We think about tough tech, changing the way the industrial complex operates, whether it's upcycling, it could be changing the processes for the production of cement or steel. Those things are very important. Clean energy mobility, right? So it's electrifying the fleet, whether it's buses, consumer vehicles, trucks, heavy duty trucks. Like there's so much work that needs to be done in and around that space. And so when you put all of those together, you have a massive global opportunity. And what JP Morgan can do is attract capital and commit capital around those. And it's delivering a product suite. Let's take from a credit standpoint, the value proposition that JP Morgan has, particularly within the green economy, is to walk through literally every phase of a company's life cycle, right? From A round, pre-revenue to multinational $50 billion publicly traded market cap, everything in between. And so the credit suite of products that we have need to come with the right structure at the right time with the right advice. And so we do have the capabilities of delivering venture loans, right, to companies that are at one point of their life cycle, earlier stage, in partnership with venture capitalists, right, who are committing their equity. We have the ability to do asset-based lending, working capital loans, project financing, and then, of course, institutional financing that lends itself to one-day investment grade related, ESG related bonds, right? So that's the value proposition ultimately that JP Morgan has. We also have on the equity side, private capital markets team focused on the best technologies, the best management teams, and making sure that they see the light of day, making sure that they are aligned with investors around the globe who are incented to see these platforms succeed. And so we're in the process now with a handful, it's more than a handful, a pipeline of credit and investment banking, capital raising transactions that are focused on all 5 of these technologies or companies within these verticals. And of course, the public markets, right? If we think about the investable universe 3 or 4 years ago, there wasn't more in the United States anyways, it wasn't more than $50 billion of publicly traded equity for the likes of not Blackstone, but BlackRock, right? Or Fidelity, companies that might have historically focused principally on the public markets. There just wasn't an awful lot to invest in. And so now there have been so many initial public offerings, whether it's in the traditional format or SPAC IPOs, that has expanded the universe of offerings for mutual fund investors, public company investors, where the market cap is for this universe now exceeds, within the renewable space alone, $300 billion. So our job as a bank is to make sure that these investable stories are done so to provide incremental capital at every stage of these companies' life cycle. So that's what's so exciting about the green economy from my perspective. And we have a team of practitioners around the globe helping companies get to those places.
Great, thank you so much. That level of detail is so meaningful to those of us who aren't doing that every day. I want to turn back to Elizabeth, because we've just talked about some of the tools that banks have at their disposal, and I'd like to think you talked, Elizabeth, about the important tools that you have in your hands-on way in private equity. So before I go back to Colleen to talk about the public sector, Elizabeth, I would love to ask you, how is private equity unique in this sustainability ESG space? Can you talk a little bit about the ownership model within private equity and the tools that you have, the unique tools that you have to promote the proper allocation of capital to align with the goals of a net zero economy, and as well as what are the greatest challenges that you face in PE?
Yeah, it's a great question. So yeah, I'm a strong believer that private equity has just tremendous opportunity to help companies get on a lower carbon trajectory and to really help us solve the climate crisis. And I think we really have just such a fundamentally good operating model for this. So let me talk a little bit about that. So we are in the business of working really closely with our companies to make them more valuable from even pre-investment. This is in part of our conversations when we're doing due diligence, but with companies, is just making sure that the company and we are on the same page about what the value creation levers are going to be. And climate is a really important part of that conversation now. It's sort of fundamental on day one. So just as one example, in due diligence, we're looking at, we do a flash diagnostic of every company that we're going to invest in to see what the carbon emissions reduction opportunities are going to be in that company, and make sure that we're on the same page as management, or if we're going to be changing the management of the company, that we see sort of a pathway ahead on that. So it's vitally important. And then post investment, we get to work right away in terms of partnering with the companies to make them more valuable. We have a team of people inside Blackstone that we call our portfolio operations and asset management team. And this is all that they do, right? They're not on the pre-investment, looking for deals. They roll up their sleeves and they work with companies daily to help them improve. They work on sourcing board members for companies. They work on making sure that the management team can execute the strategy that they've put forward. They make sure that they have the right technology systems in place, right? The right sales strategy. And so for us, climate is just one of these issues that is now totally integrated into the value creation plan of the company, and our portfolio operations team rolls up its sleeves and works with the company. And I think this is something where expertise and scale really helps us, right? So a lot of these companies, even if they sort of know what they might do to reduce their carbon emissions, they don't necessarily have the level of expertise to actually execute it, nor the time and the resources. And so we can provide that to them, right? Because we're scaling our expertise sort of across many portfolio companies. So we can, makes financial sense for us to have a portfolio of people who can work across our companies. So post-investment on the carbon emissions reduction front, they first look at the highest return on investment things that can be done, of course. Energy efficiency is often that first thing. Then we look to on-site renewables. Then we start thinking about CapEx that we can do, either off-site renewables, other energy efficiency things, changing fuels within the vehicle fleet of the companies. And so we're really just working side by side with these companies. I think an important part of this too is not just implementing those changes over the time of our ownership, but making sure that the management team can carry forward this mindset and this culture of climate smart management post our investment, right? We expect that these companies are going to continue on their climate journey after our ownership, and that's very much our intention. But just a point on our ownership too, I think that's another place where private equity has an advantage in many ways, is that we can look to the long term, right? We're owning companies and we can look over the longer term. So we can talk to companies about making capital investments that pay off over longer periods of time. Some of our vehicles are actually even perpetual capital vehicles. So we will own these assets forever. So there are just tremendous opportunities there. And I think the final thing that I would say about this that I found just be very exciting and meaningful for us is that companies now are looking to us when we're pre-investment, right? When we're talking to companies about why you should take our capital versus maybe another investor's, this is a competitive advantage for us now, right? Is having a really strong team of climate experts to be able to offer the company, and now more and more companies know that they need that expertise, right? It's the right thing to do. It makes them more valuable, and increasingly the regulations are going to be demanding this of them. And so for us as an investor, this is a point of comparative advantage, which I think is exciting and an interesting development for the world.
Great, thank you so much. All right, Colleen, I'd like to turn to you. So we've heard about some of the tools that banks have at their disposal and that private equity have at its disposal. I'd like to talk about public institutions in Europe. You have been involved in the creation, launching of some of the most important green bonds in Europe. I would love to understand if you could share some thoughts about what are the most important tools that public institutions in Europe have at their disposal, as well as if you could touch on the idea of global cooperation, perhaps the ways in which public institutions globally, maybe through the network for greening the financial system or otherwise, can work together to use these tools in the most effective way.
Thanks, Sarah. And I want to maybe build into my answer some of the points that Brian and Elizabeth mentioned, because reflecting a bit on what both of you said, I think what we've seen in Europe is that we initially let it all run by the private sector, but it simply didn't move. So we actually had to have the public sector leapfrog it in order to encourage the private sector to move in that direction. And I think for many years in Europe, we've been thinking about that. I think, unfortunately, for several years, the US wasn't part of the Paris Agreement where we made progress. I'm very glad that the US rejoined the Paris Agreement again at the start of the Biden administration. But what we've seen in Europe is that we take every chance we have to push for a greener economy. So part of the COVID-19 recovery, our recovery plan, which is also more than $1 trillion, 30% is committed to be in green bonds. So the European Union will become the biggest green issuer in the world. So in a way, if I may encourage the US, if the Biden administration really wants to commit, why doesn't the US go for 30% green bonds? The first US Treasury bond, green bond, would be a great next step. And I think then also the private sector will follow, right? So that for me would be real leadership, but that's a bit to challenge the debate. What we also have said in Europe is that this has to be democratically carried. So the Green Deal, which is a bit like the New Deal after the Second World War, went through the European Parliament with 751 members representing 450 million people, and it was approved. So it's not one party in favor and other against. The whole European, all European citizens in a way believe that this is something we have to work on. So there is a real support, democratic support to move forward. Now, we wanted to push it one level further, which is what we call the EU taxonomy. And that links a bit to what Brian said about transition. So what do you do with energy? So how do you move from brown coal to solar energy? And part of the EU taxonomy is to first require every single listed company in Europe to have full disclosure on their ESG. It's not a nice to have, it's a legal obligation. It's a must, so they have no choice. So if you're listed in Europe, you must disclose that. And that there is a strong push from investors to move, for example, from brown coal to solar, to hydro, to renewable energies. That is also financed through green bonds and transition bonds, which are also a new sector. What's interesting in these, and I think you mentioned it, Brian, the difference between equity and fixed income. The fixed income market is larger than the equity market. So that's why I always focus on the bigger piece of the pie. And in this bond market, you really see a use for proceeds. So you're looking at how is the money used. And when I do roadshows and I have to sell my bonds across the globe, from New York to Tokyo, I get now in every single meeting questions about ESG. What is our own carbon footprint, as Elizabeth mentioned? So we also have a carbon footprint report on our website. What do you do to help the COP targets being reached? So in every discussion, and some of these roadshows are also organized by JP Morgan. So there's also a bit of a connection with Brian's firm. Another point that Elizabeth mentioned, where the public sector leads, at least in Europe, you spoke about real estate and your impact on real estate. Part of the recovery package of Europe, this $1 trillion+ deal, and financed by 30% of green bonds, is to switch real estate from old energy consuming to hyper modern, carbon neutral. So if you want to move in that direction, you can finance yourself through that public finance next to private sector financing. So that, I think, is where we are really trying to push as Europe to leapfrog. But you only solve climate change if you work together, right? So I hope that leadership role that we have taken, that it will entice also the US to join that race even faster. So that's my hope for maybe at the end of this session, that we get more people excited about this.
Great, thank you so much. That's really, that's very helpful. I want to follow up on your comments because obviously most major financial institutions don't just play in a domestic market. These firms are major global actors that operate in multiple markets, including in Europe, even if they're headquarters in the United States. And clearly, as you mentioned, the EU has been ahead of the United States in the climate-related regulatory space, although the Fed has now joined the Network for Greening the Financial System, and the Securities and Exchange Commission, which does mandate certain environmental disclosures and has made clear that climate-related disclosures are included under existing regulations, has recently stood up a climate task force within the SEC to study this, and we fully anticipate that the SEC will be adopting at some point in the near term new proposed regulations with respect to climate and ESG related disclosures. So Colleen, for you, one of the key questions that arises in sustainable finance is how to determine whether an investment is green, whether the commitments are real or just fanciful puffery. Greenwashing is a serious concern in this space. Mm-hmm. You mentioned the EU taxonomy. The EU has also recently adopted the Sustainable Finance Disclosure Regulation to address the concerns about greenwashing. I was hoping that maybe you could kind of take a step back and explain the taxonomy and the Sustainable Finance Disclosure Regulation. To whom do these rules apply? How do they work? And what impact you anticipate that they'll have in addressing concerns about greenwashing in the financial sector?
Thanks, Sarah. And I agree with your first points. I do see that the US is now stepping up its game and joining some of the global networks. The rejoining of the Paris Agreement, which I mentioned, joining the NGFS, or the Greening the Financial System network, which is led now by one of the European Central Bank managing directors. So I see, and Biden also announced the greenhouse pollution reductions by 2030 and net zero by 2050. So I do see this positive move, and I'm very I'm encouraged to see that, and I hope the delivery is going to come. There's, I think, two flagship regulations that we in Europe implemented, and maybe to explain it for non-experts, it's a bit like if you buy organic food, you can label that something is, and learned that when I was at Wharton, you can label something as natural, but it doesn't mean anything, right? It can be full of pesticides, it could be very fatty, etc. But if it's natural, it doesn't say anything. The moment you create a regulation and say, well, this is organic food, but what does it mean that it's organic food? That you can use only I don't grass-fed and open air cows, that you can use only certain pesticides, etc., so that it's healthy for you. The moment you get that label, you know that you comply with that regulation, so that it's really good for you. This is a bit what we are trying to achieve with the EU taxonomy. So it goes into a lot of detail to basically say what is green, what is not green, what is dark green, what is light green, and it goes into real details. And it's a very heavy regulation from that perspective. But also, what is the impact that it has, for example, on climate risk? Now that's regulation passed in October through the European Parliament again, and will go live in 2022. So the way I see that, and I wrote an op-ed together with an American Finnish professor in Columbia, you can use it as the Brussels effect. So she describes it in a book where Europe often says the gold standard in these type of regulations, and then others follow. So in her book, she describes Nebraska farms that comply with EU regulations on pesticides because they want to access the global market. And if the US regulation is not sufficient, you scale yourself up to the regulation of Europe. Similar for GDPR, which is data protection. You need to push it up to a European level in order to become a global player. So here, Europe is really becoming a powerhouse, and with the EU taxonomy that goes into these nitty-gritties, what is green and what's not green, to avoid greenwashing, to avoid what we now see some companies are arm factories but want to issue a green bond. So I know you kill people, but at the same time you're green. That sometimes from an ESG perspective raises question marks on human rights. So that is, I think, where in Europe we try to take a leading role.
Great, thank you so much. So Elizabeth, I'd like to turn back to you because obviously you are a global player in this space. How do emerging global regulations on disclosure broadly, including but not limited to the Sustainable Finance Disclosure Regulation, affect Blackstone and other firms in the private equity space? Do you foresee the United States catching up and harmonizing standards with the EU, sort of a la the Brussels effect? Is it problematic for you that the European standards are different from US standards, that they're not harmonized?
Yeah, it's a great set of questions. This is an area of a lot of work and a lot of internally, and just a lot of collaboration across the firm too, because as Colleen mentioned, it's changing rapidly, right? So this is a very quick moving space, and it's important to stay abreast of all of these developments. I think I would say, for, which is an important point, especially as it relates to this discussion and these new task forces that have been created around the world on greenwashing. I think, it's just really important. It's certainly fundamental to Blackstone that we always only commit to goals that we feel we can, completely confident that we can hit, and based on, past experience. So we have a lot of experience doing that, and that's what we've done in our climate work. And so because of that, we really welcome these regulations and sort of greater guidance from the marketplace on transparency. I think there has been historically a lot of confusion, and it's created, what I think one of the things that I worry about, in addition to confusion for governments is just for our own investors, right? We spend a lot of time trying to make sure that we're providing useful information to our investors, many of whom have their own climate commitments, right? So our limited partners and our private equity funds have climate commitments. Our shareholders, we're a public company, our shareholders have climate commitments. And it's a lot of work to gather data from our portfolio companies. I mean, certainly a Blackstone corporate, we're also gathering data and concerned about our climate risks and opportunities. But I think where we have the biggest impact and sort of where it's most meaningful is through our portfolio. So that's where I'm concentrating my remarks. When we're we want to make sure that the information we're gathering from our portfolio companies is useful to our investors and to regulators. So I think so. We really welcome the SFDR, the greater guidance on transparency, the taxonomy, which is, for those of you who have not sort of looked at that and followed that, I mean, it's really fascinating to see sort of this level of detail now provided to the marketplace in terms of energy transition and other environmental issues and other ESG issues. So I think all very good developments. I do think that, so as a global institution, we do focus on regulations around the world. Right now, very much agree that the Europeans are sort of leading the way on this front. And so we follow that, knowing that it will working to adhere to the SFDR and especially the Article 8 and 9 of our SFDR. So these are the more sort of advanced funds. You self-classify basically into whether your funds, how much they promote the energy transition and environmental attributes. And so those higher level, more aggressive funds, I think working to prepare one of your funds to adhere to Article 8 or 9 is frankly a very good experience really for being prepared for any regulations around the world. It doesn't completely set you up to be ready, but it is, I think, a very good exercise and to go through across your organization. So very much welcoming that. I think it is, we're looking forward to sort of the final guidance being set, because it's if you're developing funds while the regulations are not totally set, that can cause a little bit of confusion and uncertainty. So we welcome the progress towards finality on that front. I think we also think a lot about reporting to PRI. We are a signatory to PRI, and reporting according to TCFD, which is the climate. The PRI, the climate specific part of PRI aligns with TCFD. So we've been putting a lot of thought into that as well. And I think we will continue to do that sort of across our whole organization. We can talk, if helpful, about TCFD and what it requires, but that's a point of interest for us as well. I would say I don't foresee probably that the US and Europe are ever going to be totally aligned on these fronts. I mean, there's maybe someday far out, but I think at this point, probably it's important to sort of track both and be able to adhere to both, frankly. But all good developments, I think, because for many years we did not have this level of guidance, and I think it's really helpful for us, although it is quite a bit of work to follow. It's helpful for us, helpful for our investors, certainly helpful for our portfolio companies as well, where the ultimate changes on the ground are happening.
Great. Wonderful. Thank you so much. And the professor in me needs to leap out and explain the acronyms, which is to say that the PRI is the Principles of Responsible Investing, and the TCFD stands for the Task Force on Climate-Related Disclosures, which is a multi-stakeholder organization created by the Financial Stability Board several years ago that is kind of the leading framework for disclosing climate-related risks. And while it's a public standard, the goal is to have reporting entities use this framework in their mandatory reports, so to the SEC. And they're required to focus on 4 pillars: governance, strategy, risk management, and metrics. And so it's a way of, even in the absence of public law regulation in the United States, of creating some kind of standardization for public issuers to disclose their climate-related risks. So end of Professor Hat. Brian, back to you. So from your perspective, are standardized disclosures valuable or important, or To what extent are they valuable and important to your capital allocation decisions? What kind of climate-related disclosures are most important? And should these disclosures in the United States be standardized in some way? Or do you think that voluntary disclosure regimes and rules are providing banks and asset managers with sufficient information to make informed underwriting and capital allocation decisions?
There's a lot in that question, Sarah. I love it. I'll do the best I can. I'm going to call it a process, right? And
Right.
so the process where you're right, Colleen, right? Europe is farther ahead of the United States. Give us some time. We'll get there, I hope. And so the process is discovering the opportunity, the problem, the acute need for better disclosures. And that starts in a voluntary fashion. And maybe it takes place in so many pockets, right? Whether it's non-for-profit organizations just looking for better transparency, or other for-profit advisors, where take Sustainalytics as an example, just trying to make sense of the noise. And where we are is further ahead, but not yet at a point in time where we have conformity and we have complete mandatory disclosure. So in financial markets, in order for those financial markets to be deemed truly efficient, there needs to be, for investors, access to what is important for them in making investment decisions. Since we're related to, most of us, Wharton, and others have attended fine institutions, we're really focused on, right, as investors and company disclosure, 10Ks, right? When any point in time a company decides to go public in the United States, there's something called an S1. It's the Bible for what a company does, how it makes money, and risk factors. The SEC has put forth really important guidelines for all companies to adhere to around risk factors. And so the more clarity we have around the importance of climate risk, the more we'll end up having a robust set of risk factors that will have a meaningful impact on people's willingness to make that investment decision. So that's what I'm focused on. I do think that, right, COP26 has provided a really attractive framework, but we're not yet at the stage where it becomes compulsory. And I do believe that we'll end up getting there. And it is taking a good bit of time because of the great level of care around making sure that whatever disclosure is out there that gets put out there strikes the right balance, right? That people can actually adhere to this form of disclosure, that they have the right risk and control environment in order to produce that level of disclosure, and that it doesn't somehow impede companies' ability to access the public markets. And so it will take time, and we're on that journey, but I'm confident that it ultimately will get done.
Great. All right, we have now come to the portion of our session where I'm going to moderate some Q&A from the audience, and we've received a number of questions. And in some cases, I'll ask the question as it was submitted directly, but in other cases where several questions touch on the same topic, I'll make an effort to kind of combine them into a coherent whole. So the first topic that I'd like to raise is on is there a trade-off between profit and being green? And if there is, how important is profit as compared to climate change in your investment decisions and financial evaluations? So I turn this one over to Brian and Elizabeth.
So I'll start, but Elizabeth, right, being an investor in largely private equity, is going to have a different take on it. I'll focus on a couple of years ago, it was show me, right? Investors, from our perspective, from advising companies as they were accessing, whether it was the private or public debt or equity markets, it was a show me story that had actually made a difference from a valuation standpoint. Today is very different, right? In the US public markets, companies with growth and ESG, a true ESG story, not a greenwashed ESG story. They're, from an enterprise value to EBITDA perspective, 3 times more valuable in the public markets than simply companies with growth. And so they are 18 times more valuable from an EV to EBITDA perspective than the S&P 500. So the market has flipped. There's so much more of a focus on these technologies, right, that may not, even in many cases, are not profitable today, but that's a very large addressable market. They've cracked the code to commercialization, and investors are paying for it.
Yeah, I mean, I agree with that wholeheartedly. I think, and I lived through the past clean tech bubble and then burst at my former private equity firm. So I can speak with confidence that this is entirely different. This is, I think I completely, agree with what Brian said. And I think some examples just are that, there are profitable investments to be made sort of across all sectors. So certainly in the renewable energy sector, as he mentioned, it's just shown to be commercial. Lots of solar and wind are in many cases cheaper than coal. We've seen what's happened with the coal industry. I mean, nobody would want to have been invested in that over the last 5 years. So I think, but then it's also consumer products. The customers of consumer products want more sustainable businesses. Investors want more sustainable businesses in their portfolio. So those are the buyers of the companies we're owning right now, right? Our other investors. And so there is this premium, I think. I will say, though, I will acknowledge that, I think for certain sectors, and this is gets back to actually sort of where we were at the beginning of the panel, there are certain sectors in the economy that are going to be hard to decarbonize, right? And we are using them right now, all of us, right? So fossil, there are either industries that are heavily reliant on fossil fuels, such as cement, right? Building materials, airlines. And so I think the models right now to profitable investments in some of those places are just more challenging. I think there are going to be some amazing investment returns out of those sectors of our economy, but they're just not quite as clear cut right now as other sectors of the economy in terms of being sure that you're going to get a green premium and you're going to have a better return by investing sustainably.
I see, Colleen, that you have raised your hand to jump in on this question as well. So I would love, as a professor, to call upon you. Please share.
No, I also wanted to come on the premium part, because next to issuing bonds, I'm in charge of our 80 billion investment portfolio. So we are investing in fixed income, which is fascinating from a profitability point of view. And I'll give an example. Germany issued a test case where they issued a brown bond and a green bond a year ago. So there was, when you issue it, there was a greenium. So you paid 1 basis point less to the market if you buy a green bond, but the market loved it because it's a green bond. Now, we also buy this type of bonds. What's interesting, if you follow it in the secondary market trading, they are now away 8-9 basis points. So if you bought that green bond, you actually are making far more profit today than if you have bought the brown bond that gave you 1 basis point more. We saw that in October also with the European Union first green bond, which also had this greenium. They issued 12 billion, 125 billion of interest, also a lot of hedge funds. So you see a large part of the investment community trying to join that green bond market because it performs much better. So it gives you far higher profitability than the brown bond. So that is also in my space in fixed income, where you really see a difference next to what Brian said in equities.
Well, even Colleen, for non-investment grade, which is often the world in which I operate, the disparity is even greater. As in, for companies looking to issue off of a balance sheet that is inherently green, that disparity relative to other peers that are less green is somewhere in now it's 25 basis points, if not more. So this is a very good sign that credit investors, equity investors are placing a premium on companies that are truly green.
All right, so we've received a question about the continuing investment in fossil fuels. According to the Fossil Fuels Finance Report of 2021, many global banks continue to invest in fossil fuels, including JP Morgan. We also sometimes read stories about major fossil fuel firms seeking to divest themselves of assets, which are then purchased by private equity firms. How is the continuing investment in fossil fuels consistent with pledges to decarbonize the economy, as well as to achieve net zero goals in the timeframe that that these institutions have pledged?
Elizabeth, do you want to take that one first?
Sure, I'm happy to. So let's see, there was a lot in that question. Because I think I was also noticing another question related to oil and gas on carbon footprints themselves. So I think I'll just address that one too. I think for oil and gas companies, I mean, certainly a lot of the pressure and I think a lot of the impact currently and in the future is going to be on their products, right? Not necessarily from their own operations. Like at Blackstone, for example, we of course care about our own carbon footprint, but our real focus is with our portfolio companies. I think it's important just on the products to acknowledge that not all fossil fuels are the same, right? So this is a broad swath that is supporting right now, I think probably over 80% of our energy use around the world is some sort of fossil fuel base, right? So there's coal, there's oil, there's natural gas, and I think there's certainly one of the things that we're very attuned to is that there are large portions of the world, again, these portions of the world that don't necessarily have reliable energy sources right now to develop their economies. So in emerging markets that are on coal. And in those situations, I think it's quite aligned with the trajectory towards the Paris Agreement to bring in natural gas and be able to finance natural gas to replace that coal, right? You are ultimately reducing the carbon footprint of the world. And so I think that that's an important consideration when we're thinking about where the fuel is going to and who it's being used and what's displacing it. I think obviously in developed countries, we're now seeing a shift from natural gas to either in places where you need heat power, and therefore you can't use solar or wind and batteries. Biomass has been a very interesting replacement. I know Colleen probably has a lot of knowledge of this because it's really, I think, taking place first, that transition in Europe. And then in other places where it's electricity that's being provided, certainly bringing on solar and wind, we're seeing that. I mean, for us, that's been a sort of tremendous investment opportunity and really shift very quickly. I would say over the last few years we've gone from our energy funds, more than 3 years ago, were heavily invested in fossil fuels. And now we are, really not investing in fossil fuels at all and have this huge scale of investing in renewable energy and other climate solutions, as I described at the beginning. So it's been sort of a total 180 for us in terms of our energy investments.
So for JP Morgan, look, I saw the Q&A line before and the Rainforest Action Network, and it's the case where JP Morgan touches every part of the global economy. And it's hard to argue that energy isn't a meaningful part of that global economy. It takes time. It takes a very thoughtful approach to migrate a global economy that was historically heavily reliant on fossil fuels to keep the lights on. And we are more electrified today than at any other point in this information age, than at any other point in the history of mankind, right? And the actual energy needs over time will increase, not decrease, right? So there has to be a sensible solution to take a global economy from where it is to a better place. That better place is a decarbonized future where it's right, there still are fuels, but sustainable aviation fuel, You mentioned, Elizabeth, biomass, right? Anaerobic digesters, renewable natural gas, so many other alternatives out there. It's not just solar and wind, although that's critically important. The reality is that fossil fuels will still projected play a part in the energy future. It's just a smaller part. And we need other technologies to combat against, right, the emissions that are created from the use of fossil fuels. And so it is a challenging place to be. There is no doubt. And it's easy for me to focusing clearly on the advanced technologies of the future. That's my day job. But there are other folks at JP Morgan who are spending all of their time focusing on how to get folks further back on the spectrum of this energy transition to a place where I reside each and every day. It is hard. And what I would say is JP Morgan is spending so much care and time and energy making sure that we don't upset the apple cart, but we move at a pace that's fast enough to meet our global ambitions for carbon neutrality. So it's a work in process. We've set the framework to do that, and very carefully, and making sure that we transition, but without material disruptions that might result in us operating literally in the dark.
Thank you. So we've received a few questions about regulation, and as a lawyer myself by training, I of course am very interested to hear our panelists' thoughts on those. We've obviously talked a lot about climate-related disclosures and the need to combat greenwashing, but there are obviously more stringent forms of regulation, including carbon taxes. And so one of the questions relates to the extent to which a carbon tax would change your investment strategies and your business model. And a second question, relatedly, how much do you see regulation driving innovation and investment opportunities? And how does that differ from drivers that are purely private and market-based? What type of new regulation or public policy, if any, do you see as being the most successful in assisting the green transition? So I'll open that up to any of our three panelists.
I mean, I guess I would just say on the carbon tax question, I would categorize a carbon tax in terms of transition risk. So we talked at the beginning about physical risk, right? Of course, which we all understand, chronic and acute physical risk from climate change. But there's also great transition risk in terms of, which is what we spent most of our time talking about today, in terms of thinking about how the climate change impacts our investments. And so I think in terms of a carbon tax, it's something, at least at Blackstone, that we are already incorporating, and have been for several years, this idea that there are externalities in carbon emissions from companies that will likely someday, right, cause negative value to society, but that will be incorporated increasingly into the value of companies and for investors. So I think for us, it's whether there is a carbon tax, we're sort of trying to act, and the investment teams, part of training and making our investment teams climate smart is really incorporating this idea of a carbon tax, even if there isn't one already. I do think, more broadly speaking, one of the things we've seen over the last few months in the energy markets is that greater guidance and greater coordination, not just in one country in the US, but globally, is going to be really important to this transition, right? And it'll help us all with this transition be more orderly and probably quicker if there is more guidance from governments and more regulation around this. So I think that's a really important thing. I think there have been, there's been a lot of discussion about what's caused these price fluctuations and dislocations. And I think there are a lot of reasons that don't have anything to do with climate change, but we see that as we do this energy transition and focus on climate change, greater guidance from governments is important. And on the second question, I mean, I think there's tremendous value from governments and public sector financing and academic institutions, right? Like Penn and others, in terms of having a focus on basic research right? And basic research is just critical to solving the other half of what's needed in terms of climate solutions, right? What we don't already have. And just because we need to solve the climate crisis over the short term doesn't mean that we're not going to need to have research that actually pays out over the even longer term, right? Because the world is growing and economies are growing. So I just think that certainly there's a lot of interesting innovation happening from the private sector, and I think the private sector has a critically important role to play. But I also just think that the government has basic research impacts that are really important, and then also financing, so bridge financing, the loan guarantee program at DOE, things like this that are actually focused by governments on scaling things up so that commercial investors can invest at scale.
Great. Colleen?
Yeah, maybe I can add, and Sarah, you mentioned it nicely. There is climate disclosure, which is the SFDR, which Elizabeth also spoke about. So the Sustainable Finance Disclosure Regulation. The EU taxonomy is also about disclosure. But what is a hard law to reduce greenhouse emissions is the climate law, which, for example, the European climate law was adopted 30th of June 2021. Now, what does it mean for markets? And I'll give you an example. Royal Dutch Shell, the oil company, we spoke about oil, they presented their business plan this year and was rejected by investors. And they brought Royal Dutch Shell to court in The Hague that their targets were not ambitious enough. The court ruled them right. So the Shell CEO had to revise the business plan in order to reduce gas emissions. The Dutch pension fund said they will pull out of Shell and other companies. Now, why, as Elizabeth rightly said, we need to look at it at a global level. 2 weeks ago, Shell said that it will delist from the Netherlands, it will delist from the EU and go to London because the UK rules are lighter than Europe. Which is a question: do you want that legislative arbitrage or not? So here, I think we need. It's great to see investors in actions. It's great to see finance really work as it's supposed to work. But as long as there are offshore places where you can comply with rules, you're not helping the world forward. So this is, I think, one of the main things we need to focus on in the coming years.
Pro carbon tax.
Sorry, say that again.
I am, and JP Morgan is pro carbon tax. There needs to be a functioning, liquid, financeable, transparent trading system that pairs, right, the emitters with right, a marketplace who produces carbon offsets, right? So if we can have, this is around the public and private partnership. Elizabeth, I love that you mentioned the Department of Energy Loan Programs Office. Like, they're doing really good work. There is a way for the private sector to help accelerate their ambitions. We're trying to do our level best at JP Morgan to find ways to do that. There are public and private partnerships, even at the municipal level in the United States, around efficiency. Commercial property assessed clean energy is one prime example, CPACE. So there needs to be a meeting of the minds between policy and the private sector to create a system, a marketplace that promotes putting a price on carbon. And the more that happens, I think those market forces will drive the right outcomes. It's a shame, right, where there is this disparity of disclosure requirements that do exist around the globe. And the more that we can set up these marketplaces, the fewer areas there will be for companies to hide.
Wonderful. Well, we have come to the end of our time, and I am so grateful to our three panelists for taking your time today to speak with all of us. It has been very educational, and in particular to hear all three of you together, because I think that there's been so much synergy between and among your comments and experiences. So while you cannot hear the literal applause of people in the room, I will virtually lead a round of applause on behalf of all participants at this conference to thank you so much.